Warren Buffett paid 3 times book value for sCandies in 1972, a price he initially refused as too expensive. That rule-breaking decision has generated over $2 billion from a $25 million investment. His biggest winners, all mistakes he almost didn't make. For 15 years, Buffett had told his partners exactly what he would buy and what he wouldn't. These weren't casual guidelines. They were written promises published annually in partnership letters that went out to every investor who trusted him with their money. Buy stocks at 50 to 75% of intrinsic value. Prefer companies trading below 15 times earnings. Purchase at or below book value. Always demand a margin of safety. This was the Buffett doctrine, printed in black and white, year after year from 1956 through 1969. These rules came straight from Benjamin Graham, Buffett's mentor at Columbia. Graham had created a quantitative framework for value investing that was almost mathematical in its precision. You could screen for it. You could measure it. You could prove to your partners that you weren't gambling with their money. Buffett called these investments cigar butts. Companies so cheap you could pick them up off the ground, take one last puff, and still make money even if the business was mediocre. The formula worked. The partnership was generating returns that made Buffett a millionaire before he turned 30. But then came 1963. American Express was imploding. The company had guaranteed the warehouse receipts of Allied crude vegetable oil, and it turned out those warehouses were filled with seawater, not soybean oil. The salad oil scandal, as it became known, threatened American Express with hundreds of millions in liabilities. The stock collapsed. And Warren Buffett started doing something he'd never emphasized in his partnership letters. He went to restaurants. He watched people pay with American Express cards. He talked to restaurant owners. He asked travelers about their card preferences. This wasn't balance sheet analysis. This was qualitative research into brand loyalty and franchise value. The kind of soft, subjective investigation that didn't fit neatly into Graham's quantitative formulas. What Buffett discovered was that customers didn't care about the salad oil scandal. They loved their American Express cards. The franchise was intact, so he invested $13 million, 20% of the entire partnership's assets, in a single stock, trading at approximately 20 times earnings. That last number is the one that should make you pause. Buffett's stated preference, published in his letters, was for stocks below 15 times earnings. American Express exceeded that limit. By most accounts, it violated the very screening criteria Buffett had promised his partners he would follow. The result? American Express returned approximately 5 times his investment within 2 years. It became one of the partnership's most profitable positions ever, and it taught Buffett something that would take him another decade to fully internalize. Sometimes the best investments don't pass your own rules. Fast forward to 1972. Buffett had closed his partnership. He was now running Berkshire Hathaway, and Charlie Munger was pushing him to look at a candy company in California, sCandies, a beloved brand with loyal customers who bought boxes of chocolates every holiday season. The business was earning $4 million a year before taxes. The owners wanted $25 million. Buffett said no. That price meant paying 5 times pre-tax earnings. It meant paying 3 times book value. For 15 years, Buffett had built his reputation on buying cigar butts at or below book value. Companies so cheap that even if the business deteriorated, you could liquidate the assets and still make money. sCandies was the opposite of a cigar butt. It was expensive by every metric Buffett had ever used. Charlie Munger kept pushing. He argued that C's wasn't just a candy company, it was a brand with pricing power. Customers didn't buy C's because it was cheap. They bought it because it was C's. That meant the company could raise prices without losing customers. That meant the earnings would grow. That meant paying 3 times book value wasn't expensive if you looked at the future cash flows instead of the current assets. Buffett resisted. He wanted to pay no more than $25 million for a business earning $4 million pre-tax. He was still thinking like a cigar butt investor, still anchored to book value, still following the rules he'd written for himself. Munger finally convinced him. They paid $25 million, 3 times book value, a complete violation of the investment philosophy Buffett had practiced for 15 years. and it became the best investment decision of his life. sCandies has generated over $2 billion in cumulative earnings from that $25 million investment. Not a $2 billion valuation. $2 billion in actual cash that Berkshire used to buy other businesses. The candy company became a cash machine that funded acquisitions for decades. And Buffett has said repeatedly that if he'd stuck to his cigar butt rules, if he'd refused to pay 3 times book value, he would have missed the investment that taught him how to build real wealth. Now here's where the pattern gets interesting. Those 2 investments, American Express and sCandies, weren't anomalies. They were the beginning of a complete transformation in how Buffett invested. When he bought Coca-Cola in 1988, he paid a premium to book value. When he bought Apple starting in 2016, he paid a massive premium to book value. The biggest positions in Berkshire's portfolio, the ones that generated the most wealth, all violated the quantitative rules Buffett had written in his partnership letters. In his 1989 letter to Berkshire shareholders, Buffett finally admitted it in writing. He said his biggest mistakes weren't the bad companies he bought. They were the wonderful companies he didn't buy. The sins of omission. He acknowledged that his original Graham-style quantitative rules, the ones that made him a millionaire, were too restrictive for building the kind of wealth he wanted. Buying at 50% of book value was safe, but it meant missing companies like sCandies that could compound earnings for decades. This creates a genuine paradox. The rules that protected Buffett from bad decisions also prevented him from making his best decisions. The quantitative discipline got him in the room. It kept him from overpaying for mediocre businesses. It gave him the credibility and track record to raise money from partners, but the investments that actually made him billions required breaking those rules. They required qualitative judgment about brand value, customer loyalty, and pricing power. Things you can't screen for in a stock database. So what do you do with this information? Because the obvious danger is rationalization. Every investor who overpays for a speculative stock can claim they're following Buffett's example. They're breaking their own rules for a quality business. They're thinking long-term. They're betting on franchise value. And most of them will be wrong. The difference is in what rules Buffett broke and why he broke them. He didn't abandon discipline. He didn't start buying lottery tickets. He broke his quantitative rules for businesses with specific qualitative characteristics. American Express had customer loyalty so strong that a financial scandal didn't dent card usage. sCandies had pricing power so strong that customers paid premium prices year after year. These weren't growth stories or turnaround hopes. They were established franchises with economic moats. Buffett also broke his rules reluctantly. He initially refused to buy C's at 3 times book value. He had to be convinced by Munger. That reluctance is important. It meant he wasn't looking for excuses to overpay. He was genuinely wrestling with whether the qualitative advantages justified the quantitative premium. Most investors do the opposite. They start with the desire to buy, then look for reasons to justify the price. There's another crucial detail. Buffett broke his rules after years of following them. He had the pattern recognition that comes from analyzing thousands of companies. He understood what book value meant and why it mattered before he decided it didn't matter for sCandies. He knew the risks of paying premiums because he'd seen investors lose money doing exactly that. His rule-breaking came from experience, not ignorance. Your investment framework should evolve. That's the real lesson here. The rules that serve you at one stage of your investing career might limit you at the next stage. Buffett needed Graham's quantitative discipline when he was starting out. It kept him from making catastrophic mistakes. It built his track record. It taught him how to analyze businesses. But once he understood those fundamentals, once he'd internalized the discipline, he could layer on qualitative judgment. The key is knowing when breaking your own rules represents wisdom versus rationalization. Wisdom is recognizing that sCandies has pricing power worth paying for. Rationalization is convincing yourself that an unprofitable tech startup is the next Apple. Wisdom is doing qualitative research on American Express customer loyalty. Rationalization is ignoring financial metrics because you believe in a founder's vision. Wisdom comes from understanding the rules deeply enough to know when they don't apply. Rationalization comes from wanting something to be true. Buffett broke his rules for quality franchises with pricing power and customer loyalty, not for speculative growth stories, not for turnaround situations, not for companies that might become profitable someday. He paid premiums for businesses that were already excellent and would stay excellent. That's a very different decision than paying premiums for businesses that might become excellent if everything goes right. Here's the uncomfortable truth. Most investors should probably follow the rules more strictly than Buffett did. The quantitative discipline he learned from Graham would serve most people better than the qualitative flexibility he developed later. Because most people don't have 40 years of pattern recognition. They don't have the experience to distinguish between a sCandies and an expensive mistake. They're more likely to rationalize bad decisions than identify genuine exceptions. But if you've put in the work, if you've studied enough businesses to understand what makes a franchise valuable, if you've developed the discipline to say no 99 times out of 100, then maybe you're ready to recognize your own sCandies moment. The investment that violates your rules but makes sense anyway. The one you almost refuse because it's too expensive by your usual standards. The one that might generate returns for decades if you can overcome your own discipline. Buffett's written criteria served as starting guidelines, not absolute constraints. The investments that violated his published rules became his greatest winners. And the framework that made him a millionaire had to evolve before it could make him a billionaire. Your rules should protect you from bad decisions, but rigid adherence to those rules will eventually prevent great ones. The art is knowing the difference.